Okay, so just an introduction. I'm JabVFX, a forex trader turned crypto trader for 4 years now. So I traded every single market: Euro USD, meme coins, majors like ETH and Bitcoin, and altcoins like Aave, Fartcoin even. So I've been using the same strategy that I'm about to teach you guys that works. For any single market that you may encounter, you can apply the same thing. So this is going to be a three-part video. This will be the first part. Okay. So before we get into the strategy, I need to tell you guys what the purpose of trading is compared to hodling, the popular term, or the hold on for dear life, right? So right off the bat, it's avoiding large amounts of drawdown. Pretty simple, right? Pretty simple. And the second one is for compounding gains. Now let's get right into it. So for example, over here, let's say you found a nice key level here and you got in here. This looks like a reasonable stop, right? And I won't get into the strategy just yet, but it would look something like this. For example, you caught 75% of the move, right? You caught 75% of the move. You took profits. You didn't hold forever. Keep in mind, you did not hold forever. You took profits. We had an entry point, an invalidation or stop loss, and we had our take profit, right? So if you go on Twitter and you post your trades like I do, you'll obviously get a few comments saying, "Oh no, you missed 6%. Oh, you missed, what is this? 3%. You're missing so much, right? You're selling the bottom, right?" So many comments like that on people who think they know what they're doing, right? And guess what? Those same people, they're gonna get liquidated on this 30% drop, 32% drop, right? Or let's say even further, they're they're all in at this point because they're euphoric. Everybody's saying, this is a Solana chart. Everybody's saying we're going to 1,000, right? At this point, everybody's saying, "Oh, we're going to $1,000," and suddenly we're down 40%, right? And us traders, we capitalized on the trend. The trend. We capitalized on 75%. And we avoided the 40% drop. And guess what? It would have been very close to our entry. So we would have round tripped our gains, right? We would have round tripped our gains. So the people telling you, "Oh, there's still room for 5%, right? Oh, there's still room for 10%. You're selling the bottom." They're exactly the same people who get liquidated on this move down, right? Think about it. Now, how can you get liquidated in an easy market? This is an easy market. You just buy, you know, when we're in a bullish trend, you just buy. And then you sell on key levels or you sell when we break the trend, right? At the minimum, you'd be able to sell when we break this moving average for 50%. That's still a 50% gain, right? If you have a small port, $1,000, $10,000, 75% is big, right? All the more if you have a bigger account, 100,000. All of a sudden, that's 75K, right? Think about it. Now, let's say you're a hodler and you're stuck here. You're stuck in this trade because you didn't take profit and you went through this drawdown because you're getting bullied on Twitter for selling the bottom, or people are telling you, "Don't worry, just buy the dip, buy the dip, buy the dip, buy the dip, buy the dip," and suddenly you're out of money, you're down, and what now? You're stuck. You're a community member. You're stuck holding, right? When do we get back break even? Look how far this is. We're break even after 213, 212 days, guys. Think about that. You have the hold mindset, the hodl mindset, and you're only in break even after 212 days, right? Now you can't tell me that you're gonna have the same mental capacity, the same mental health, the same 100% performance that you had here versus when you held through everything up until here. You can't tell me that you're not going to be mentally affected. Your psych, it's not going to be 100%, right? Because me, I would be devastated if I saw my profits disintegrate like this, right? So it ties on with avoiding large amounts of drawdown. And if you're in drawdown, your mental health suffers. That's just a reality, right? You can't tell me if you're in a 100K account and you're down, what, 10%, 20%? You can't tell me that you're not affected just a little bit, right? So that's why we trade instead of hold. We trade, we capitalize the trend, and we get out when we lose the trend. Simple as that, right? Let's say the opportunity arises, the same opportunity here arises here. I would take that trade. For example, it's something like this. And we'd be targeting, the highs, because that's just how it is. Once we reclaim trend, we run it back higher. Now, let's say we lose this. We lose the trend over here, and this is our exit. That's still 11.38%, guys. Now compounded. 11.38 plus 75.95%, and you're up, what? Like 87%? Again, instead of holding all the way down here, right? And using that same example, if we just held this trade, we would have been stopped out, right? So we have to know. That's the purpose of trading. Traders, we know when to capitalize, and we know when we're wrong, when to get out. Okay? So for example, we do the same thing here. Something like this. Okay. Is it run it back time? Run it back, run it back. Oops, we lose the trend again. And we've only managed to capitalize on 10%. 10% gain. See? Suddenly, 10 plus 11 plus 76, and we're close to doubling our account. Again, instead of just holding all the way down, right? Let's say we capitalize it on it again. For example, over here, this is something, if I saw this, I would have entered here, right? There's a good key level right at our trend, something like this. And guess what? We'll be able to hold it again because we keep running it back. We keep running it back, right? At best, you can get 76%. And if you hold it until we lose the trend, let's say we lost the trend over here, that's 50%, guys. Now add it up. 50 plus 10 plus 11 plus 76. What is that? Almost triple the account, right? Remember, we capitalize on the easy part of the market and we get out when it gets difficult or when we lose the trend. So let's say something like this. We don't participate in the 23% or even lower. We don't participate in the 26% drawdown. Or if you want to do it from top to bottom, right? 34%, right? We do not hold when the market tells us to sell, right? 34% drawdown. Again, you cannot tell me that after round tripping all of these gains and it goes here very near your entry and you tell yourself, oh man, I round trip my gains, right? You can't tell me your mental is not affected. Okay, so as traders, we exit. We do not want drawdown. We exit when the market tells us to exit. Do not hold, right? So if you're this guy that's still been holding through all of this, guess what? You're still not even at your max take profit, right? Feels bad. Feels very bad. So, moving forward, guess what? We found another opportunity. And suddenly, we can capitalize on it again. When we lose the trend, guess how much we're about to lose right now. Losing this trend alone, we're down 57%. Guys, if you did not take profit from here, if you just held, stopped out, stopped out, stopped out. Even the initial entry, all the way from 1 year ago, you'd get stopped out, right? 1 year of holding only for you to get stopped out because you listen to, crypto Twitter. You listen to some randoms telling you that you sold the bottom and to just hold forever, right? While actual traders are telling you to capitalize on trends and to exit when you need to exit, right? So if you add all of this up, suddenly we're at the 3x, while price hasn't even moved 2x. Oh, it has. But it eventually retraced 57% drawdown, right? So that's the importance of trading. We avoid large amounts of drawdown while compounding our gains, right? Because everybody's going to tell you, oh, hold for 10x, hold for 100x, 20x, right? But what are the odds of you holding 10x? What are the odds of a coin of Solana going 10x from, what's this, like 150 or 200, right? What are the odds? Not so high, if you ask me. Not so high. So, now that we've gotten that out of the way, let me just clear this up. Now that we've gotten that out of the way, let's talk about candlestick anatomy, right? Let's talk about the candlestick anatomy. Now, I like to do it very simple. So a wick and a body. That's just how it is. Now, a wick often indicates what? Reversals. Now, the body indicates continuation. Keep this in mind at all times, okay? Keep this in mind. Now, for simplicity's sake, let's use the daily. Okay. So, wick equals reversal, body equals continuation. Let's begin. So, over here, we have a candle body, and this is the wick. Body, wick, top wick, bottom wick. Okay. So, what do we see here? When a candle gets wicked, right? It is indicative of what? Where are my words? It is indicative of what? Reversal. Okay, let me give you two examples. What is this? Wick to wick. What happened after that? Reversal. Okay. Second example. Wick to wick. What happened? Sell off. Okay. Now, inversely, you see the same thing. What is this? Wick to wick. What is this? Wick to wick. What is this? Wick to wick. Wick to wick. What happens after that? Reversal. Reversal. Okay? Now here's the thing. From wick to body, okay? Wick to body, that's a continuation. Okay? Wick to body, continuation. Okay? Very simple. Very, very, very simple. That's really all there is to it. Other people will just explain it as wick and body, but I like to give my my candlesticks some signals, right? A wick can give you signals of reversals, and the body will give you an indication of a continuation, right? Simple enough. Okay, so now let's talk about the trading time frames. This is very underrated, a very underrated topic, because everybody thinks, oh, you're a trader. You trade the 1 minute chart. You trade the 5 minute chart. No, not only that. Yeah, you can trade the 1 minute or the 5 minute or the 15 minute, but you can also trade the 1 hour, the 4 hour. You can also trade the daily, the weekly, right? Each of these time frames, they have their own purpose. Okay, so let's begin. 30 minutes and below. Honestly, even 15 minutes. This is for scalping, right? You're in and out quickly. You play the 1 minute, you play the 5 minute, you're in and out. 10, 15 minutes, max like an hour, you're just in and out. Okay. Next, we have the 1 hour to 4 hour. Now this is for usually swing trading, which is my personal favorite. Now, why is it my personal favorite? Well, it's because I'm able to get the meat of the move while having a tight enough stop loss for a good risk to reward, right? And last, we have the daily, the 3-day, to even the weekly. Now this is for long-term trading, like a month minimum, month, 3 months, 6 months, up to even a year, honestly. Now, I don't really trade this because it's too long for me. It's too long. And since it's a long time frame, it takes time to materialize. So my risk to reward, my stop losses have to be quite wide, right? So one thing to keep in mind though, this is where a lot of traders they mess it up with the time frames. Okay, remember that the daily, 3-day, weekly will always be more prioritized, to always have more priority than the 1 hour to the 4 hour. And the 1 hour to the 4 hour will always have more priority than the 15-minute and below. So you cannot tell me that, oh, I'm trading the 5-minute, but my targets are daily, right? No, it doesn't work that way. So if you scalp the 1 minute, the 5-minute, your targets should only be the 15-minute. So if there's a 15-minute range, you can only trade the 15-minute range for scalping. That's the rule of thumb. Obviously, there are exceptions, but for a better, win rate and risk to reward, that's what you do. And for the 1 hour to the 4 hour, you can technically trade within this own range, right? If you do the 4 hour and the weekly, sometimes it doesn't happen. Sometimes. So that's something to keep in mind, right? For example, I'll give you guys an example. For example, the 4 hour is bullish, but the 15-minute is bearish. Simple exercise. What do I follow? 4 hour bullish or 15-minute bearish? 5, 4, 3, 2, 1. Obviously, the 4 hour, right? So I cannot try to short based on 15-minute bearish candles and then get surprised when I'm stopped out, right? Suddenly price goes parabolic. And you ask yourself, why did price go parabolic? Well, it's because the 4 hour is bullish, right? Simple as that, right? So if you want to play that, then the time frames that you are in, 15-minute bearish, the 1 minute should also be bearish. Then this is a higher chance of trading well, going to your take profit or something like this. This is good. The 4 hour is bullish, the 1 hour is bullish. Right now, the best thing to do is when every single time frame is bullish. The daily is bullish, the weekly is bullish, the 4 hour is bullish. Now this is the highest probability setup that you can ever have, right? So that's something to keep in mind. You don't always have to do this. There are trades that don't require you to have every single time frame in congruence to each other, but that's just something to keep in mind, right? You cannot be surprised if you get stopped out doing this strategy on this strategy, because this will always take priority over this. Okay? Simple. Okay, so now let's talk about the market sessions. So there are three. We have Asia, London, and US Open, or New York Open. Same thing. So now there are metas here. If you haven't noticed, for the past month or two, we've been getting Asia London pumps, and then US Open or New York Open or Stock Exchange Open, same thing, dump. Right? Dump or manipulation, whatever you want to call it, dump into a continuation right after. this is how we frame it. Asia to London, and then this manipulation is New York Open, US Open, right? So what do you want to see? For example, we're bullish. If we're truly bullish, then usually it goes something like this. There are two scenarios. Okay, something like this. So this is Asia session and London session. And there's a key level right here. A key level right there. And then let's say 8 p.m. it does this. It does that. Right. And then US Open, we get manipulation, some trap there, both sides, and then the continuation higher. This usually happens in the New York session, this one. So we trap traders in both sides, trap longs, trap shorts, and then we continue higher. So if you're an intraday trader and you want to position, make sure you either position after the manipulation or in the morning in Asia or London session. So you might think, what the hell am I saying? So let's get into the charts, shall we? Here we go. This is July 9. Okay. 9th of July. Here we go. Asia session, 6 a.m. It goes up all the way up until London session, 3 p.m. And guess what? Here we go. Starting here. Let's mark that area. Okay. So up until this point, this is Asia session. Sometimes it's 6 we'd like to think it's 6 a.m. 6 to 8 a.m. is Asia session. And then London is 3 p.m. onwards. And then US Open is 9:30 p.m. So that's something to keep in mind at all times. You don't really need to know exactly what happens before that. Like the time, you don't have to be super, to the dot. But you just have to think about New York session, which is 9:30 p.m. That's when the manipulation happens, and that's where the continuation after happens. That's where the real move is. Okay, so moving forward, we get this 2.4% move. New York Open. What happened? We get a sell-off. We get a manipulation higher. We sweep this. Manipulation higher. Okay. And then manipulation lower again. And then after the New York session, 2 a.m., we get the real expansion, right? And if you look here, it's all just wicks. And like what we've said, if it's all wicks, signs of reversal. So we failed to close below any of this, therefore we went higher, right? Manipulation, very simple. Okay, next. After that, let's mark out 6 a.m. again. 6. Okay, until 9:30 p.m. Okay, so this is the move of before 9:30, Asia to London, and once we see the US Open, we get manipulation higher again to trap traders, trap the longs, and then we go down, trap the shorts. Trap the longs and the shorts, trap both of them, we sweep, and then we go higher, right? Now this is the real move. Usually the real move happens around midnight or 1 a.m. And then that's when we continue higher, right? So you don't really want to position before that. If you're an intraday trader, if you're a scalper, you don't really want to position before the US Open because high chances of you getting swept out. You initially want to position yourself after the manipulation has happened, right? So we saw this expansive move, and this is a good area, key level, and there you have it, right? It's a good move. Now it's the same thing. So this is, we're looking at this move. So possibly we get both sides again and then higher. That's how the meta has been for quite some time, and that's how it's gonna be. Because in a bullish scenario, the manipulation will always be to shake out traders. Always, always. Something to keep in mind. The agenda of the market maker in a bullish trend is to shake you out before going higher. So, when does that manipulation happen? That manipulation happens at US Open. So, possibly we see this, key level, and continue higher. Now it's the inverse for bearish scenario. So for the bearish scenario, it pumps all the way, keeps pumping, and then goes down. Like that's literally it. Let me see if I can find like a bearish scenario. Here we go. Here. Okay, here we go. So this is 6. This is 9:30. Okay. So here's what happens, right? So technically, you don't really know what's happening here yet. We're still ranging, right? And 9:30 happens. We spike up. We, the market maker tells us, go long, guys. We're going higher. We're going higher. And right after that, we just melt, right? That's usually what happens. In a bearish scenario, for example, like this, in a bearish scenario, the manipulation will always be up before down. And in a bullish scenario, the manipulation will always be down before up. That's just how it is. That's how it's always been. That's how it always will be. So that's something to keep in mind at all times. You don't have to position, but you don't have to get shaken out as well. Like for me, when I see bearish price action before US Open, I'm happy because it means that we're going higher. But if you see price soaring before US Open, then you know that something bad's about to happen, right? That's just how it is. That's how it's always been. Like for Bitcoin. Looking at Bitcoin, this is a chart that I showed in the Discord channel. So what happened here? Okay, let me just break it down for everybody. So 6 a.m. Let's mark that out. 6 to 9:30. Boom. So we're bullish. Obviously, this is bullish structure, and we've had a range here. And guess what? Right? What have I been telling you guys? US Open manipulation down. We sweep this, this this liquidity, we sweep it, and then we just go higher. That's just how it is. So if we look here, right, what's the range from? This is quite a big range. From here to here, so possibly we'll see something like this. Like, that's just how it is. So you don't always have to do something about it, but it gives you a way to predict what the market wants to do, right? You don't get shaken out. Oh no, we're going lower. Oh no. But then you know the knowledge that for price to go up, it must manipulate lower to shake out traders or to take out long liquidity, right? That's just how it is. All right, now let's get into the meat of the strategy, the foundation, guys. Now I need you guys to completely understand what I'm about to tell you next, because this is the most important part of our strategy and any strategy to begin with. This looks extremely simple, but if mastered, this is all you need. Okay, let's begin. Market structures. So, what are market structures? Simple. Higher highs, higher lows in a bullish trend. Lower highs and lower lows in a bearish trend. Extremely simple, right? Right, guys? But what if I told you this is where exactly people go wrong? Okay? So, let me introduce a few more concepts. Failed structures. For example, we have a failed low, which is bullish, and a failed high, which is actually bearish. And I'll give you my secret sauce, which are assumptions, right? I'll get into that a bit later, so stick around. So for now, market structures, guys. Anyone can tell you, any 5-year-old, 10-year-old can tell you that this is a bullish trend. Why? Why is that? Wait, let me just complete this. Okay. Why is that? Because we're making consistent higher highs and higher lows, right? Very simple. This is a higher high, and this is a higher low. Now, for example, coming up down here, yeah, this is where you can say it's a higher high, this is a higher low, this is a higher high, this is a higher low, this is a higher high, and obviously what's next is a higher low. Very simple, right? That's bullish. So, on the other hand, now we have a lower low. This is a lower low. Lower high. Lower low. Lower high. Lower low. Now, obviously, what comes after the lower low is a lower high, right? Anybody can identify this. You can identify this. You know, a 5-year-old can identify this. Your mom can identify this. Extremely easy. Very, very basic, right? Very, very basic. But when it comes down to the practical use, that's where people make a mistake. Same with my mentees. I give them this simple exercise, and this is where they make the most mistakes, because they don't know what exactly constitutes a higher high or a higher low, or what exactly constitutes a lower high or lower low, right? Simple enough. Let's continue. Now we have something called failed structures, right? So what happens if, let's move this a bit. What happens if we have a higher low? Correct, that is a higher low. But we did not create another higher high. What now? What now? This is called a failed high because higher high, higher low, higher high, higher low. What's after that? A higher high. But what did we get? A failed high. And why did I say it's bearish? Because if there is no failed high, then possibly price has already reached exhaustion. And what comes after that probably is a lower low, right? Now, for us to truly confirm the bearish trend, we should make a lower high followed by a lower low again. This is the only time we can, truly say that the trend has shifted. So suddenly, let me just mark it here. Suddenly, we have a failed high and we have a lower low. What happened? Suddenly, we have a lower high and we have a lower low. So, what's the relevance of this? For example, you have a long here. For example, you have a long because you longed the higher low and you're now expecting a higher high, right? So, suddenly, you're not TP hit. Suddenly, there's a failed high and it goes deeper into your entry and you're like, yo, what is happening? What is happening? So just this move itself, the failed high and the lower low, already gives you some kind of inkling, some kind of sign. Maybe price has exhausted and I might get stopped out, right? So what happens here? You see a lower high and this confirms your bearish trend. I'm out. I'm out of this. Oops. I'm out because it confirmed that we're bearish now. So I'm out at this level and I would have gotten stopped out, right? Same concept over here. Okay. So let's say you have a short. Let's say here you have a short. Just for example, you have a short here. You have a short here, you're targeting here. And guess what? There's a failed low. What's the problem? Let's write that down. Suddenly, there's a failed low. And what did I say? A failed low is bullish. Why is it bullish? Because if price can't seem to push down and create another lower low, then we have a problem. If you're short, you have a problem. But if you're bullish, then that's a good sign. Because inverse to this one, we're seeing exhaustion as well. Now, what happens is you see this. Suddenly, you've created a higher high. What happened here? A failed low and a higher high? We've probably switched trends. And guess what? It makes another higher low. What's happening? So the safest thing to do is get out because this structure is suddenly looking like this structure, right? They're no longer looking the same. This is possibly the beginning of a reversal. And true enough, you get stopped out. And that was, oops. And you make another higher high, right? That's how to analyze the markets. And that's how to do it. So, what is this assumption you're talking about? What is this assumption? Okay, let's get into that. So, what is the assumption in a bull trend, right? The assumption in a bull trend is we keep creating higher highs and higher lows. That is the assumption. So let me just make this a bit. So higher high, higher low. So if the bull trend, your assumption is we continue to create higher highs and higher lows until proven otherwise, what is the assumption after this higher low. What's the assumption? What is the logic for this trade? Obviously, a higher high. The assumption after a higher low is a higher high. Now, what happens if that assumption has not been met? Suddenly we get a failed high. So now, we are getting invalidated. Our assumptions are invalidated. Therefore, there might be a change in trend. Same thing here. We are creating lower highs and lower lows. It's a bear trend. Any bearish trend will continue to make lower highs and lower lows until proven otherwise. So now the basis for this trade, is okay. After the lower high, what is the assumption? Another lower low. Now, it didn't happen. There was a failed low instead of a lower low. Our conditions were not met. Therefore, possibly a reversal is about to happen. Right? So we continue the assumptions. Suddenly, there's a higher high. And now the assumption is that, okay, we're creating a higher low. Manipulation happens if we get a higher high, but then we end up making a lower low. That's manipulation. However, if this continues, then we possibly have switched trends, reversed. Okay? That's the secret sauce. Assumption. You always have to think in assumptions. Right? That's the logic of why we're trading. Why are we trading? Why are we taking longs? Because the assumption is that after I enter the higher low, the assumption is that we will create another higher high. Right? That is the assumption to everything. So, let's begin. So, looking at this hype chart, let's pretty much begin here, right? So we're breaking this structure. So now we made a lower low, right? Very simple. A lower low. And what's the assumption after lower low, right? What's the assumption? What is the assumption? A lower high. Oops, we got it. This is the lower high. Sorry. Lower low, lower high. What's the assumption after a lower high? There we go. A lower low, right? Very simple. A lower low. Okay. What's the assumption after a lower low? A lower high. Okay. And as we continue, this is one whole leg. As we continue, this is a lower low, right? Here's where things get interesting, guys. Here's where things get interesting. After the lower low, we're expecting a lower high, right? Okay. What happened now? What happened now? Did this produce us a lower low? I don't think so. I don't think so. What happened here? Failed low. Did it fulfill our assumptions, guys? No, it did not. Failed low. Okay. So if you're in a short, this is your sign to somehow probably get out. Or wait a bit, probably, right? So now, all of a sudden, what is this? We get a break. And now, we're in a higher high. Quite interesting. Quite interesting finds. So, if this is truly manipulation, we're supposed to continue lower, right? What happened, guys? What happened? Oops. We have a higher low. We have a higher low. It's respecting our key levels. And suddenly, I think I want a long. Because we've reversed. Okay. So here's where things get very interesting. What's our assumption, guys? After higher low, what's the assumption? Higher high. And suddenly, we have a trade in our hands because we did create a higher high. See? We did create a higher high. This is our higher low. Now, this is now the higher low. Guess what? This is our higher high. So we keep creating the higher highs and the higher lows. Now here's where things get interesting again. Okay, higher low. Okay, what's the assumption after higher low? Quickly, you guys can say this in 4 seconds, right? After a higher low should be a higher high. Should be breaking this. We should be breaking this. However, we see a failed high. It's looking quite similar to this, huh? So now, we might want to get out of our longs if we were in one in the first place. And now, we break the higher low. Our failed high fulfilled its duty of reversing. And now, we're back to regular programming. We're back to being bearish. This is now our lower low. Right? Now we're our lower low. Suddenly, this is our lower high. And we continue. We continue to create lower lows. Right? Somehow this is a lower low. Then this becomes a lower high again. So now, suddenly, we are confirmed bearish again. So what does that mean? It means we can position ourselves again. So after lower low, guys, what's the assumption? What is the assumption? A lower low. Again, we have a trade in our hands, guys. So look at it. We have the higher highs, higher lows, failed high, failed low. This is how we navigate the markets. Now tell me if you can navigate this without having assumptions in mind, because it's our guide. If you always assume what comes after this, what comes after that, then you won't be confused as to where we are in the market, right? Now the thing is, what I like to do is I like to have a story between the interactions between the bears and the bulls, right? Because the market is just a battle between the bears and the bulls. Who's going to win? Who's going to win? So at this point, the bears were winning. Suddenly, this is the first sign that the bulls are in control. Okay, higher high. The bulls are in control. Higher low. Bulls are in control. Higher high. Bulls are in control. Failed high. Suddenly, the bears are fighting back. And the bears took over. Lower low. Lower high. Bears are taking over. Lower low. Bears taking over. Oops. Lower high. Lower low. Moving forward. Let's continue. So, lower high. We break this again. Lower low. Okay, here we go again, guys. Things are looking quite interesting. So after the lower low, what happens again? Suddenly, why is there a higher high? Why? Possibly manipulation? Possibly? Suddenly, there's a failed low. What is this? Why is there a failed low? Are we reversing? If this is manipulation, once again, would have brought us lower. But no, 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 no. We have a failed low in our hands. Therefore, the same thing, the same mindset that we were thinking here, we apply that same mindset here. So we're now looking for bullish continuations, okay, to position ourselves. Okay, so now failed low. Now we have another higher high. Because we're breaking this, by the way. That's why. Because we're breaking the higher high. So now this is confirmed. Suddenly we have a higher low on our hands. Quite interesting. Higher low on our hands, right? So if there was an opportunity for this sweep play, possibly that would have, gotten us like a 1 hour trade, but that's besides the point. Now, higher high. Pretty much this is one leg as well, so I'd say this is the higher high because the pullbacks are very shallow, not really telling. So that's a higher high. Now we're at the higher low again. So if you wanted to position, you could position again. And where's the next higher high? We're breaking this. Higher high, higher low. We're breaking it again. Higher high. This is a higher low. Higher high, higher low. So here, after this higher low, what happened? We did not break this. We now have a failed high again. So if you're in your longs, it's time to get out. Now we're breaking this. Now, suddenly, it's a lower low again. Lower low, and suddenly failed low again. This is our lower high. This whole move is the lower low. This is the lower high. Guess what, guys? Guess what? We have another trade in our hands. There's a failed low. There's a failed low because obviously after the lower high, what's our assumption, guys? What's our assumption after a lower high? It's a lower low. So did we break this? Yes or no? 3 seconds. 3, 2, 1. We did not break it. I'll answer it for you guys. We did not break it. We have a failed low in our hands. Guess what? Higher high. So after the failed low, we have another higher high. Therefore, I'm willing to position long again. Guess what? Key level. Long position. Easy target. Because guess what? After a higher low, what's the assumption, guys? A higher high, right? Or you can even go as far as this. Because structure-wise, we're going higher, right? So that's just how to frame it. This is exactly how I do it. This is exactly how I teach my mentees. This is how we think in assumptions. Higher high, higher low. If there was a failed high, then most probably will be, invalidating the bullish setups. So, true enough, lower low, lower high, lower low. And inversely, the failed low has been presented. Therefore, we may be invalidating the bear case. And guess what? We did. We got our higher high. And it gives us an opportunity for a trade. Right? That's exactly how we do it. So I can go on and on and on and on about higher highs and higher lows. But you should be able to tell me, like right now, what the trend is here. The bull trend. Higher high, higher low, higher high, higher low, higher high. Now it all depends on where you want to enter, right? So higher high, higher low, higher high, higher low, Failed high, guys. Remember what happens after failed high? A sell-off, right? And if we had this knowledge in our heads, if we figured out the secret sauce, then we would not have longed here. If you wanted to short, do what you want to do. But we know that a failed high will most likely cause lower lows, lower highs, lower lows, sell off. Guess what? Suddenly, we're breaking structure. Suddenly, there's a failed low, higher high, higher low, higher high. Suddenly, we have another trade in our hands, guys. See? And can you guys tell me what the assumption is after a higher low? A higher high. Very, very simple concepts. You can even go as far as this, right? Because we know we're in a bullish trend. We've reclaimed that bullish trend after the failed lows, the higher highs and the higher lows, and the continuation of the higher high, and our positioning at the higher low, and the knowledge that we have to assume based on logic what comes after a higher low is a higher high, then suddenly trading becomes quite simple. Trading becomes quite simple because we always have a story in our heads and we always use the concept of assumptions. Now this is something I coined myself, the assumptions, but you'll probably see it in other courses, but simplified version, this is just how you should be looking at the market, right? So quite simple concepts that I suggest you guys practice on your own, right? Because it's quite simple. You can just backtest wherever you want to go and write down these letters, LLLH, right? And you can check it out for yourself because that concept works. And I've been using that concept for the longest time, right? Okay. So now we're going to talk about breakout structures. So I've mentioned about market structures, right? Higher highs and higher lows. And I've mentioned a bit about breaking structure. Like, okay, we broke structure here, we broke structure there, yada yada. So let's get into it. 1, 2, 3. So this is a break of structure to the upside, meaning bullish. So tying it again with our assumptions, a higher high, a higher low. The assumption after a higher low is a higher high. So we must get a break of structure to the upside. So if you give me a chart like this, and you tell me you have a long, where will my, take profit be based on assumptions after a higher low in a bullish trend? Remember, it has to be bullish. It should be the higher high. After a higher low is a higher high. Now, this is what you call a break of structure to the upside. When we continue breaking structure to the upside, then that's bullish. Same could be said of the opposite. If we are breaking structure to the downside, that means something like this. We're breaking structure. We're breaking structure. We're breaking structure, right? To the downside, that means we're in a bearish trend. Simple. Now there is a criteria for break of structure. Like I've said previously, if you've been watching since the beginning, what did I say about continuations versus reversals, right? So let's say you have something like this, and this is a wick. This is a wick. Yeah, something like that. Not the best, but this is what it is. There. So wicks often indicate reversals and bodies are continuations. Okay? So what if we're in a bull trend and we get something like this? Is this bullish or bearish? Is this a true break of structure or not? Well, to put it simply, it's not. Because like I've said, continuations should be candle bodies. So, okay, what now? What will make you say that it's a break of structure? Well, if it looks like this. Now we can say this candle body, right? There's a break of structure and a candle body. That's when we can truly say it's a continuation, right? Simple concepts, very simple concepts. Now, if we put market structures and break of structure together, let's just go back to what I was saying because for simplicity's sake, here we go. So, guess what we have here? That exact picture that I painted for you guys happened here. So what is this? Is this a break of structure to the upside or not? 3, 2, 1. It's not, right? Because it's a wick. And what do I keep reiterating about wicks, guys? If there is a wick, indicative of a reversal. So, it did reverse, right? It did reverse. Now, here's the thing. You can say the same for the opposite. Is this a break of structure? 3, 2, 1. No, it's not. Because it's just a wick. Therefore, what happens with a wick? Reversal. Okay? Simple. So now, what is this? This one. Is this a candle wick break or a candle body break? It's a candle body break. So what do I keep saying? A candle body break equals continuation. So we have broken structure to the upside. We've created a higher high. Therefore, we're bullish. And this trade suddenly is valid. So, same thing here. This break of structure is a continuation because it's a candle body. What about this? It's just a wick. Therefore, it reversed down. Okay. What is this? Just a wick. Therefore, it's not a true break of structure. Right? So, on the opposite side of the spectrum, what is this? Candle body break. Therefore what? It's a true break of structure. Okay, look at this. Just a wick. Therefore, reversal and rejection. Boom. This one was technically not a break of structure because no candle body closed, therefore it reversed. Right? Now the true break of structure was here. Right? Candle body close. Right? Simple. Very, very simple. Same thing here. Candle body close. candle body close. Here, just a wick. Therefore, what do I say with wicks? Reversal, which it did. It reversed. So, here. I have a question for you guys. Is this a break of structure? From this to this? This? Yes or no? 3, 2, 1. No, it's not. Because it's just a wick. Right? But the true break of structure is at this next candle because it is a body. Right? It's very, very simple. So we continue the break of structure. We broke this as well. Let's speed it up a bit. We broke structure here too. Right? So here, guess what? No longer breaking structure, just a wick, so we reverse. The true break of structure is here on this candle now. This body, so this body, this body, right? So you guys can practice again by yourselves. It's very simple. So now you know what the break of structure is. Now you know what the true continuation is. A continuation or reversal, right? Now you know market structures. Now you should combine the two, break of structures and market structures, and suddenly you have probably like 70% of the strategy, because you know the market direction, you know the assumption, you have a basic knowledge of what price is about to do, right? When I tell you, or when your family or your friend tells you, at this point, what's price going to do? With knowledge of assumptions, you know it's going to go up, right? Right? What about here? If your friend tells you, what do you think price is going to do here? Well, you can tell them confidently, well, we're going lower because this is a lower high and we're in a bearish trend, and the assumption is that we create a lower low. So you can tell anyone what price is about to do at a particular period of time because of the concepts I just taught you guys, right? So very easy. Now this ends part 1 of the video. For the remaining parts, part 2 and 3, this is where we talk about the strategy, supply and demand, moving average, and ultimately how to execute the trades, right? Entry, SL, TP, and a little bit of psychology, right? So this is exactly what the strategy is all about: market structures and break of structures. So if you reach this far and you don't understand yet what's going on, I want you guys to keep going over it, back test, and I want you guys to master this before moving forward, because this is the bread and butter. If you don't know what this is, then the strategy won't make as much sense as it would. Okay? So, yeah. Part 2 comes next. All right, so this is the most exciting part. This is part 2, the strategy proper. Okay, so the strategy comprises of two things: supply and demand, as well as the 200 moving averages. Okay, so let's begin with supply and demand, right? But what the hell are you talking about? What is a supply and what is a demand, right? To put it simply, the science behind it, let's just go into the background as to the logic behind this. So, what is supplier demand? These are basically institutional orders, okay, that are too big, that leave behind imbalances or fair value gaps, or FVG, fair value gap, which I'll explain later. Okay, so that being said, you already have quite the idea, right? So it may look like this. For example, this is a candle, and then the next one is this huge candle, and then the next one is over here, right? Something like that. Obviously not the best drawing, but let me show you. So this is a fartcoin chart. Okay, so put it simply, have you ever seen candles like this? So you see this huge impulsive candle. When I say impulsive, it leaves behind a gap. Okay, a gap, a fair value gap. How do we measure that? From this to this, right? The gap between the candle before it and the candle after it, right? It's also what you call an imbalance, right? So the candle before that imbalance is the supplier demand. So in a bullish setup, it's called a demand. And in a bearish setup, it's called supply, right? So how do we mark that? It's the last candle before the impulsive move. Okay, simple as that. Last candle before the impulsive move. Okay, simple. Now we have criterias as to, for us to tell, okay, if this demand zone or supply zone is valid, because not every demand or supply zone is valid, right? Okay, so the criteria is R. The criteria are, so valid break of structure, right? We've talked about break of structure in the past. So this is a break of structure, right? It's a higher high. Okay, so this demand zone caused a break of structure to the upside. That's a valid demand zone. Okay, number 2, it leaves an FVG. It leaves a fair value gap, hence impulsive, right? Impulsive candles leaving behind a fair value gap. Okay, that's the only time this demand zone is valid. Okay, so, and the last one, obviously common sense, you have to use context, right? If we're bullish, like in this case this is bullish, then obviously a demand zone, entering at a demand zone is, the right thing to do, right? We don't short in a bull trend, right? So it's the same thing. We shouldn't really care much about the supply zones if we're bullish. And inversely, if we are bearish, then we should not care about demand zones. Okay? So let's get into it. So here, we have a demand zone. We have a demand zone. And like I've said, these are institutional orders that have to be filled at some point, right? Okay, let me just fix this. However, guess what? After the higher high, higher low, there was another break of structure, okay? Another break of structure caused by what demand zone? Can you spot it out? Spot it, spot it. There we go. Caused by this demand zone. Now, why is it valid? Wait, let me just bring back the criteria real quick. Okay. Why is it valid? 1. Break of structure. Okay. 2. Leaves behind a fair value gap. Leaves behind a fair value gap. Okay. Meaning this is an impulsive candle. Okay. The last candle before that impulsive move is this. This is our demand zone. And lastly, context. Context. Bullish trend. Right? Bullish trend. So, we're looking for a higher low. Okay? Try to piece everything together. Break of structure. Market structures. Higher high. Looking for a higher low at the demand zone. True enough. Boom. What happened? Price returns to our demand zone. Okay. And then creates another overall higher high. Okay. So your position would be like this. Have a long order here, and we'll have just a little bit of space in case price sweeps the demand zone, right? Something like that, and then takes liquidity and goes back up. Okay, something like this. Okay. But Javi, what if I miss this? What if I wasn't awake? Well, I doubt you wouldn't be awake for this. You'd be able to enter from 8 a.m. to 12 a.m. the next day. But just in case, you're at a work trip, vacation. So, I missed this completely, and I'm depressed. What do I do? Okay, into the right guy. So, what we can do here is to play the continuations, right? So, higher high, messing around, higher low. Okay, so we got that higher low, and now we're waiting for an internal break of structure. Okay, and the first one is here. Break of structure here, another break of structure here, and guess what? Here's our criteria. This is a break of structure, internal break of structure. Okay, internal break of structure. That's valid. Leaves a fair value gap. Leaves a fair value gap. And context. We're bullish. Okay? Obviously, sometimes we don't go in a straight line. That's just how it is. We don't always go in a straight line. So, fortunately for us, if you miss the initial trade, you have another trade in our hands. Or if you want to compound, and add to your longs, then this is the exact same spot to do it. And what's our assumption again, guys? The assumption, higher high, higher low. The assumption is another higher high. Sure enough, we got it. Right? We absolutely got it. So, now what? We have a higher high. This is technically one singular leg. So this is the higher low. Not really giving us much to do. And when price breaks that, you're telling yourselves, okay, what now? What am I looking at? So it misses our demand zone by a few percent, by 1%, not even 0.8%, right? If you saw this and it was moving up already, probably could have gotten in here, some kind of a chase, right? Something like that. That's absolutely fine. Can't always be perfect with our entries. If you want to ride this move up, okay? So there was this is a break of structure here caused by, what's our criteria again? This is an impulsive candle, fair value gap, demand zone, right? This is a quite big demand zone. So trade would just look like this. Probably can go to the lower time frames to see a better entry, but for consistency, we'll stick with the 4-hour. And the 4-hour will give us the most sure trades, the highest probability trades. Not necessarily the best risk to reward, something like this, right? The demand zone is huge. So you may or may not opt out of it. So for the sake of this is valid, so we'll opt in. Okay? So now we see another one. We broke structure here again. So we see another demand zone. Again, there was a gap. And this is our first loss. Right? First loss, telling ourselves, where can price go? Where can price go? And then you tell ourselves, oh, look at this. There's a demand zone that has not been tapped yet. Oops. This is free trade. And then now we target this because we're still technically in a bullish trend. Bullish trend, and it just taps the moving average, right? This is, I think, the EMA, 200 EMA, right? So once the moving average plus the demand zone or supply zone for that matter, if they align, then this is the highest probability trade that you can ever get. Okay? The best. So you see that? And mind you, this isn't like a one-day thing to think about. This is 1 week of you thinking, okay, where can price go? Here, you see this untapped demand zone, and your TP would be another higher high. And this is actually one of my trades. If you look at the Discord, this is a trade that I gave a signal to. Okay? Let me see if I can search for it. Because it's just to show you guys that I'm actually trading. This is May 8th. Okay, let me just look for it. Boom, we got it. So if you look here, this was a signal trade that I sent during that period of time. All right, so this is just transparency that I actually do trade the way I teach. Okay, so moving on. Just got me excited there. This is how the trade looked like, right? Okay, moving on. So our next move here, we've got the higher high here. We got the break of structure here. We got that fair value gap, though not so big, but still valid. That's the one that caused that major break of structure. There's a demand zone here. Okay. Right there. Boom. So here's what I was talking about, right? Sometimes your idea could be right. However, you just get swept out. You just get swept out. Right? So it's a matter of risk to reward, right? If you want a wider stop loss, but you know, a bad, not really bad, but a lower risk to reward, or you wanna take it like a man, you know. So I'm just showing you guys that it's not always rainbows and butterflies, right? You know, we also make mistakes, we also lose. We're not perfect, but we believe that over the long period of time, let probability do its thing, numbers game, eventually we will be profitable, right? So this is just quite unfortunate. Our analysis was correct, but we got stopped up. Okay. Now, looking at this move and looking at the criteria, so we did get that higher high, right? We did get that higher high. However, criteria, valid break of structure, check. Leaves a fair value gap. Does it leave? Is there any fair value gap here? Nope. No gap whatsoever. Therefore, check, X, check. So, it's your choice, you know? If you want to take the risk, then go. But if you want the checklist completed, then that's obviously a higher probability trade. And guess what? No fair value gap, no impulsive candle. Therefore, we eventually trade lower, right? Let me just remove this. So now we are actually going lower. We're below this. Now we're breaking structure here. And guess what? Okay. Well, the same thing that applies to demand, right? Also applies to supply. So in a bullish trend, we look at demand. Okay. And what's demand again? The last candle before that impulsive move. Okay. Now, if we're bearish, we look at supply, which is still the last candle before that impulsive move. So let's bring out that trusty checklist again. Okay. Break of structure. Check. Leaves a fair value gap. Uh-oh. That's a check. Okay. Check. Context. We've broken significant structure. We're below the moving average. Therefore, we are bearish. Check, check, check. Now, where's our supply? Here we go. Here's our supply. So, conversely, we can take some shorts. And guess what? It tapped right at the moving average. So, what did I tell you guys? If the moving average and our supplier demand, if they align, then that's the highest probability trade that you can ever take in your life. Okay? Okay. So, lower low, lower high. What's our assumption, guys? Giving you 5 seconds. 5, 4, 3, 2, 1. The assumption is a lower low, right? And we got it. Okay. We absolutely got it. Now, the reason why I do not like shorting, or I prefer longs, is because in crypto, shorts are punished. Because if you look here, there's a break of structure, and if you took the short, right, probably would have gotten stopped out. And then there's a failed low. We see the failed low. You're like, okay, maybe they're going to this supply, and then you probably get stopped out again, right? So it does not favor shorts. Okay, so something to keep in mind. Sometimes it works like this. Sometimes it works like this, but I would rather, take trades on one side rather than try to take both sides, because unless it's been a bearish trend for like quite a while. So the smart thing to do is short, like at all times, if we're already in a bear market, right? But since we're still in a bull market, then it would make much more sense, risk to reward wise, and general win rate, to be pro trend, which is long, right? Okay. So moving forward, what's happening here? We got a fake out again. Where's my criteria? So there isn't much fair value gaps, therefore we don't take anything. Okay, and this is a pretty much a no trade zone. We don't like taking shorts because no trade zone. We're making lower lows, and for the first time we make a failed low. And guess what, guys? Here we go again. Here we go again. So let's bring out our trusty criteria. We have a demand zone here. Demand zone in our hands. Valid break of structure. Check. First break of structure. Second is right here. Actually, this is the first and this is the second. Why do I say that? Failed lows across the board. Failed lows across the board. And then we get a push up, a higher high. Okay? So, valid break of structure. Check. Leaves a fair value gap. Check. Oops. Fair value gap. Where do we see that? Right here. There's a gap here. Okay? Now here's the tricky part. Context. Now the context, we are technically bearish. Bearish structure, but we're breaking structure. Right? We're not respecting supply zones. Okay? So if we're truly bearish, then the supply zones are supposed to be respected, right? We're supposed to continue making lower lows and lower highs and lower lows, right? However, if you've been paying attention to part 1 of this video, then you'd know, oops, this is a failed low. Failed low right here. This is a lower high. This should have brought us down, but it did not. It did not. This is a supply zone that, it did not push price down, right? Because the purpose of a supply zone is to bring price down, and the purpose of a demand zone is to bring price up. Okay? So, again, like I've said in part 1, you have to know the narrative. Make a story. Okay? It's a battle between the bulls and the bears. It's a battle between supply and demand. So, at this point, demand is winning. Supply failed to do its job. Therefore, it's invalidated. And when supply is invalidated, then demand is in control. Okay? Inversely, if supply is respected, then expect, demand to be invalidated, Therefore, supply will be in control. But at this particular point, demand is in control. Therefore, we take some longs. Okay? Very simple. Very simple. So, higher high, higher low. What's the assumption? 3, 2, 1. The assumption is another higher high. Right? Very simple. Very simple way of framing our trades. Easy 2.26 risk to reward ratio trade. See? Even in the worst conditions, we are still able to find trades because we use logic. Okay? Okay. So, now here's where things get quite ugly. So, this is recent trades, recent price action, right? So, the higher high is here. However, our criteria over here, our trusty criteria, valid break of structure, no fair value gap, X. Context, we're trading above the moving averages. So there is context, but there is no impulsive move, no fair value gap. So if you look, right, if you've been paying attention to this session so far, if there's no fair value gap, then the chances of you winning is significantly lower, right? Okay. So no trade at all. So in this move, there's no buy entry, okay? So break of structure. Here we go again. Valid context check. However, look at this. We have our fair value gap. Okay. So this is a check and this is a long. But we get stopped out. Just the nature of things. This was the fuckery of the market during that particular period of time. So take that L like a man. This is what it is. So here we go. Recent price action. July 13, 2025, as of recording this video. So let me give a prediction. Break of structure. Okay? Break of structure caused by this demand zone, right? So bring out our trusty criteria. Bad break of structure. Check. Leaves a fair value gap. Check. Where is it? Right here. Fair value gap. Okay? 3, sorry. Context. We're above the moving average. Okay? So, I will take this trade. And we're pushing up as we speak. Okay? Higher high, higher low. What's our prediction? What's our assumption? Higher high. But if you want to be cute, you can probably target this. Because we've taken this liquidity below. And I guess we've taken this liquidity. We've taken this. And the next logical place to find liquidity is over there. All right? Okay. So let's come back in a few days or a few weeks from where you guys see this video. I did not take this trade because I'm in another trade, but you know, it's a good exercise. Okay, let's move on to another coin. BNB. Okay. What do we have here? What do we have here? Okay. So, let's what am I looking at? Well, there are a few trades that I took, that I signaled on the Discord, and that is this. So, I did not take any of these trades because it was a very weird, volatile time. So, if I were to take a trade here, it would have been this, and I would have gotten stopped out. So, just being honest here. Just being honest here. So, let's just count that as a loss, because let's be transparent, and this is where I would have taken it. Because guess what? Guess what? The criteria. Where is it? Let's bring it out. So, criteria: valid breakup structure. Hell yes, valid breakup structure. Check. Leaves a fair value gap. We did leave a fair value gap. Okay, I mean, keep in mind. Check. Context is check because massive sell-off. Okay, let's do this together. Massive sell-off, got absorbed. Okay, failed low. Okay, and we're now trading above the moving averages. So all three have been checked, and I still got stopped out for no reason, because sometimes coins are like that. BNB sometimes is weird. So, okay, moving on. The real trade that I didn't take this. The real trade was this. So, we're getting a massive break of structure, right here. Caused by what? What demand zone right here? Okay, our trusty criteria over here. Oof, my bad. Our trusty criteria, let's check it out. Valid break of structure, hell yes. Leaves a fair value gap, the biggest gap you've ever seen. So, this gap to this gap, the biggest gap you've ever seen in your life. Context, hell yeah. We are extremely bullish. Okay? So, what now? We have a trade in our hands. Right there. And again, we as much as possible, we try to save ourselves from getting swept while having really, really good risk to reward, right? So this is a 7 risk to reward, right? Okay. So, here we go. Prediction time. Assumption time. Higher high, higher low, assumption, another higher high. Bingo. You got it right there. And that's your trade. Right? And that's your trade. So, there hasn't been a higher high since then. If anything, there was a lower low and a supply zone, right? This is a valid supply zone. Valid break of structure, check. Impulsive, check. Fair value gap. Context, we've broken down, check. However, like I've said, what is this? You would have gotten stopped out, right? Because shorts are just not as good as longs in a bull market, right? The context is bull market. Okay, so let's see if we have any more trades here. And this is a risky trade, but right, let's say you've spent 13 days, 14 days asking yourself, okay, where's price about to go? And guess what? So at our initial break of structure point, there's another one here, an internal break of structure. And look, there's a demand zone here that hasn't been tapped yet. And guess what? That's exactly where price reverses from. Now, this is what I've been saying. These are institutional orders They're left behind and they have to be filled at some point. They have to. They have to. That's just how it is. Don't ask me. Ask the institutions. Ask BlackRock or something. Don't ask me. All I know is that I've been trading this for 4 years, this exact same thing, and this is what I'm teaching you guys now. Okay? So, let's move on. Let's move on to price action today. So, we have a extreme sell-off that got absorbed. Our demand zone, this is a valid demand zone here, right here. But maybe you know why? Because we broke structure here. We have a gap. And the context is we've tapped a demand zone. We are breaking structure. We are failing to create new lows, failed low. Therefore, we might be bullish. However, price never got back to this area. So it's just how it is. So we look for the next opportunity. We get another break of structure. And the most ideal is this one. We get front ran just a bit, which quite annoying, right? This is just the reality. Sometimes we don't get filled. Imagine waiting and then you don't get filled on both. Sometimes that's reality, right? So again, I'm just showing you guys what's up. So that's how it is. Continuing here, we also did not get filled here. So that's quite unfortunate, but these are all valid breaks of structure. Okay, so moving on to the next. What do we got here? What do we got here? Let me just show you guys my current trade here. Current trades, plural. Because I love Aave. Right? My mentees, probably the Discord, you guys know that I love Aave because first of all, we're bullish. Second, it respects the demand zones, right? It gives us opportunities to enter, which I absolutely love. Okay? So, let us begin. Here, right? This is the very first signal that I gave last June. What was it? June 6th, I think. So, what are we seeing here? Price just got a higher high. Got a higher high. And guess what? This is our demand zone. Can somebody tell me why this is our demand zone? Okay. So, where's our trusty criteria? Criteria, here we go. Valid break of structure, check. That's a higher high. Leaves a fair value gap, check. Look at that. Huge gap. Context, check. We are bullish, therefore taking longs is the best idea. Okay. Long right here. Assumption, higher high. TP hit. Quite beautiful. Okay. So, what do we see here? We see here a higher high, a demand zone, break of structure, which is valid, fair value gap, valid, context, valid. We took that L like a man. We took it. We took that L like a man. Okay? And that's fine. Now, price is going down. We tell ourselves, okay, what's happening here? How bearish are we? And what do I do? So, price is still maintaining structure because, well, we've only swept this. we haven't really broken down, so that's still possible, right? And this is a trade that I took right here because that's the, if you look at this area, retail, or if you guys do support, this is support, right? But more importantly, this is also a demand zone. This one right here fills break of structure, check, fair value gap, check, context, check, we're still bullish. And the assumption is a higher high. So either here or here, and we're good to go, right? We're absolutely good to go. Now, here's something that you guys can look at. So I marked this out as a possible pullback zone because there is a supply zone above here which got tapped, which eventually gave us a lower low. So that's something to keep in mind. Criteria for a supply: break of structure, beautiful, check. Fair value gap, there is a fair value gap right there, quite beautiful, check. Context, though I would not short directly from this. It's just something like a take profit target, if ever, because we kind of know, supplies have tendency to, bring price lower. And like I've said, they always have to go back. Always. So eventually, at some point in time, this was 131 days later, it goes back, right? So something to keep in mind. Just to give you guys reasons why things happen. Well, there it is. Okay, so let's move on. So we're out of the trade. There's a trade to be done here. Well, there's a demand zone here, which I took personally. I took this L like a man because I wanted, continuation. I also took this L like a man. Well, not really an L because it was technically break even. But why is this valid? Because it was also a break of structure point. Huge gap. Context is still bullish. So I took this. Okay. And there is a, let me just make this clear for you guys. This is a supply zone. And when I saw price was respecting this supply zone, I instantly got out. Okay? So, then that's a failed high for you. This is a failed high. This is a failed high. So, if you've been watching since part 1, you know what happens if there's a failed high. It's a possible reversal point, which it did happen, and I saw that pretty early, and I got out unscathed, which is good. Okay. Okay. So now things are looking quite bearish, and you tell yourself, where can price rebound from, react from? And you see there is a demand zone that has not been tapped yet. And guess what? It went up, tapped, failed low. We're now trading above the moving averages. We are now happy individuals. The broken structure. Where's our criteria? Come back here. Okay. So Okay, here, the broken structure, Checkaroni, fair value gap, there is. Now the real demand zone is this one. This is the real demand zone because there was a fair value gap here, right? But me, I'm a greedy guy and I like my risk reward very tiny. So I refined it to this one. Sometimes price just doesn't come back. And we've seen this time and time again, right? With the BNB trade where I got too greedy and things don't come back. I get front ran and my analysis was correct, but I'm never in the trade. So I took that risk here. Um, Mainly because I know that Aave loves to go back and it loves to sweep. So I took my chances here and assumption was correct. Now, here's a mistrade that I could have taken. This is the breakup structure point. There's a demand zone here. Breakup structure check. Fair value gap check. Context check. Perfect long for another continuation trade. So I did not enter that. I have no reason why. It was 4 a.m. 8 a.m. I was still asleep. I woke up late at 12 noon and the trade was done. So now we go here. So we've now broken structure again. So here's a demand zone. I managed to get in much lower. I lowered my buy average. Let me just move this a bit. I lowered my buy average here at the sweep. I'm happy. With Bitcoin breaking out of all-time high and ETH following suit, I told myself maybe we're going here to this liquidity period, and I decided not to instantly take profit. Wait, where's my long? Okay. I decided not to instantly take profit here. Well, that's the assumption. Okay. And because of that, let's just move this. And because of that, price technically came back. But then, guess what? If I wasn't in this position, this is exactly where I would have entered as well. Because bringing out the criteria, valid breakup structure at this point, check. Fair value gap, check. Context, we are bullish. So this would have been a nice trade as well. Yep. So what I just did was I added to my position. So my position is now like 3% of my account and I'm trying to run it back. So that's how to play it. Right? Too early to say, but there's a demand zone right here. Right? So possibly price could go back here. Final and move, or just go straight up. Okay? So that's how to do it. You can practice this in backtest or anything, but I'm showing you guys the raw picture here. Now, that's the main strategy, right? That's the main strategy that I use. Now for the moving averages, it's quite simple. If anything, it's more simple than the supply and demand, because it only tells you one thing: trend. So if we're trading above it, or if we're trading right at it, then obviously we are bullish. And if we are trading below it, therefore we are bearish. Now, this is where the context comes in, right? Obviously, when we're above and we're bullish, then we only look for demand zones, right? And if we are bearish, we are below, we either look for supply zones or we just don't participate in the market at all, right? Very simple, very simple. Now, here's where things get a bit interesting, right? Because some coins respect different time frames. Let me explain. So we've been using the 4-hour this far, and up until this point, we've respected, the moving average. Here, we only touch it once, twice actually, and then we never touch it again. The next time we touch it is when we go bearish, and the next time we touch it after that is when we've reclaimed it. Okay? What if I told you there are different time frames that are suited for each coin? Interesting. Cue the 3-hour. Okay. 3-hour. Touch. If you didn't enter there, absolutely fine. Guess what? Touch. Signal to enter. Okay? Touch again. Signal to enter. If you were a scalper, you would have taken this. We break it, and we reclaim it right at our entry. Right? Beautiful. So, let me explain to you why some coins have their own specific moving average. For example, here. If you like scalping or in and out quickly, there's a choice to get in here and a choice to exit here, right? Though it's not as lucrative. See, look at this. It's giving us weird signals. We're using it as a support. We break it, and then we suddenly move up, right? We use it as support, suddenly break it, and then we're breaking above, and then it's making us buy and sell. So the 1-hour clearly is not lucrative. It's not giving us good entries. So we scrap it. But the 3-hour, it's telling us exactly what we need. Right? Same with the 4-hour. Okay? So let me give you another example. Fartcoin. So looking here, respect. Here's the demand zone plus the moving average that I was talking about, right? We lose this short opportunity or opportunity to stay out, right? Basically, that's it. Let's see if the 1-hour is suitable. At some point, not really. Actually, it is. So, we're tapping here. Still bullish. We break. We reclaimed. Right? We're tapping. So, it depends on you what time frame you want to choose. Hype. Hype on the 4-hour. Look at this. For this specific period of time, the 4-hour was lucrative. It's acting as support. But during this entire run, it was not really as lucrative. But if you look at the 2-hour, guys, look at this. Suddenly, the 2-hour is telling us everything we need to know. We're using it as support. Tap. Same thing here. Tap. So, it's giving us chances to get in. Right? And for this hype coin, it's the 2-hour. For Aave, it's the 3 and the 4 hour, right? It's different for each coin. I'll show you guys something. Virtual. So virtual, we've now reclaimed the 4 hour, the 4 hour moving average, right? And if we use the demand zone, then that's a good confluence, right? Now, what if I told you there was an opportunity to trade? So right here, right? For example, you're a pure scalper. Even the 15-minute is lucrative. Could have gotten in here, right? Exit there. On the reclaim, you can ride this again, right? Same thing here. Trades below, it reclaims it, and then it just flies, right? So you need to find that specific time frame because it's different for everything. You have to find that specific time frame for the moving average to be respected, right? That's something they won't teach you. They won't tell you this. They'll say, "Oh, just use the 4 hour or the daily," right? But what if I told you that you can use different time frames for what purpose you want to do? If you want to scalp, there are some coins that let you scalp using the moving averages on the 15-minute, right? And if you want the longer term trade, then this is where it is. This is where you'd buy. Let's see in the 1 hour if it's lucrative. 2 hour. So on the 2 hour, it actually is. So we've broken down, we've reclaimed, that's your buy, right? Same thing here, right? Same thing here. Same thing here. Signal to get out, right? Not as clean, to be honest, it's not as clean. But I'm just showing you guys, that each coin, here we go. This is a much cleaner time frame. On the 15, some entry points. Look, there's even a demand zone that sits right at the moving average. See? And suddenly, you have a crazy 10 risk to reward trade. See? When's the next time it touches? It touches here. In this part. Right? So, each coin, they have their own time frame. Each coin, they have their own moving average. Okay? So that's something that you guys need to know. It's not one trick. It's not just purely 4 hour. It's not just purely the 1 hour. There are times where you can use the 15-minute. There are times where you can use the 1 hour, the 2 hour. Okay? So, where is the criteria? Okay. So for part 3, it's simply psychology, right? Now, let me just write that down. Oops. And let's use this Aave for later. Part 3 is psychology. So, what I want to put in your head, right, is the strategy is just 50%, sometimes 40%. Psychology, your mental capacity, your mental health, your ability to perform when needed be is 50% of the game. Okay? So, let me give you a scenario. 50% win rate. You have 50% win rate and you're profitable over a long period of time, right? This is at 100% psychology. 100%. Your strategy, you're executing at the perfect times, you're executing perfectly, you're good. You're performing well. Now, what happens if you're only at 50% psych? It's a bad day. You know, your boss got mad at you, or if you're studying, your professor told you you're shit, or something like that. You know what I mean? If your parents or your spouse told you off, or you got into a fight, then obviously you're not gonna be 100%, right? That's just human nature. You're probably gonna be at 50% psychology, right? I'm just giving a number here. Let's say you're just really not feeling it today. You didn't sleep well. All of these things affect how you trade. Believe it or not, it's not just the strategy. So, if you're at 50% psych, if your mental capacity is only at 50%, what happens? You tilt. Okay? You tilt. This loss here devastated you. For some reason. I don't know. Just made you feel like, I'm not good. I'm not a good trader. I suck. That's what comes into your head. Just for that specific day, because you got fired, or your boss told you your output was garbage, or your professor failed you in an exam, or your dad told you off, you didn't do some chores, or your partner, you fought with your partner. And on a normal day, this wouldn't phase you at all. But today, it made you mad. Okay? So what now? I suck as a trader. I suck. And I got stopped out. And guess what? Price just went up. I'm taking the trade again. Oh, I lost again. Now you're like extremely mad. You're mad. This is a revenge trade, a tilt trade that you shouldn't have taken in the first place. I'm stupidly mad. I hate it. So suddenly, every single slight move up, like this one, oh my god, I was right the whole time. And you minimize your risk to reward, your stop loss to make up for these two losses. Maybe this 2RR trade will make up for it. But suddenly you take another loss and you're losing it. But then if you look at these trades, our criteria has not been met. Only the first one. So your one loss is now 3 losses. And the worst part is, oh my god, we're going lower, we're going to 0. Crypto is a scam. Aave, I hate Aave. I hated Aave in the first place. Why am I even trading this? And guess what? Opportunity comes and you don't take it. This particular trade, 6 risk reward. Your loss here would have been negligible. You would have been up 5% even. If you took this L, you took 6% win, you're in profit. But suddenly, you're now 3 losses in, you miss a trade, now you're so mad. And you're just taking random trades to make up for your mistrade, your FOMO. You lose again, then yourself, oh my god, what is happening? I was right this whole time, why am I still losing? Right? And this one, of transparency, I took this trade and lost, by the way. So I'm just saying. Let's say you took this also, You're saying, okay, I missed the first one, the second one, I got stopped out. Now, this is my chance, guys. And you get stopped out again. So now, 1, 2, 3, 1, 2, 3, 4, 5. You're now 5 losses down when you could have just been 1 loss down, 1 win that negates this, and another loss. So 2 losses, but you're still 6% up. So 6 minus 2, 4%. You're still 4% up. So that shouldn't affect you at all. But now you're in 5% down because you missed a trade and you're taking suboptimal trades. And it's a cascading effect. It's a cascading effect. You're longing everything. You're longing this. Okay. Oh my god, I got stopped out. Oh, but it's going up again. It's going up, guys. It's going up. You long this. Okay. Right. Suddenly you're 10% down just because of that one day where you told yourself that you suck and you revenge traded, you tilted. Right? So that's the importance of psych. Having a good psychology and letting each trade play out individually. You know, this trade does not define who you are, nor does this trade define who you are. You're not the best trader here, and you're not the worst trader here. You're not the best trader here, you're not the worst trader here. Right? It's a game of probabilities. Now, let's go back. Where'd it go? Okay. So, at 100% psychology, you're at 50% win rate. Suddenly, when you're only at 50% psych, you're tilting, you're revenge trading, your win rate is now 10%. So, you were previously profitable and now your account is saying goodbye. You know what I mean? So, that's something. That's why we're talking about psychology. You have to be able to accept your wins and your losses. You should be able to accept that you won't win all the time. Put down the damn ego. Know when you're wrong. Okay, know when you're wrong. Because we can go 2 or 3 or 4 lose streak. For example, you didn't take this trade. We took an L here, we took an L here. And here, we're back to break even. And look at me now. This is me now watching this video. You guys are watching this video. This is a trade I actually took. I'm in profits, right? So, if you think about it, these losses mean nothing because I'm break even here after this just one trade. And the next trade, I'm up big, right? So that's something you have to keep in mind at all times. Let the numbers play out, okay? So now to sum it all up, to wrap it all up, let's count our wins and our losses, right? Just as an exercise, as to show you guys that you don't have to tilt, you don't have to revenge trade. There are countless opportunities for us, right? Despite losing, despite missing a trade, it's absolutely fine. So let's do it. 1.6 minus 1, okay, plus 6 minus 1. So that's just this session so far. Let's pull up the calculator. 1.6 minus 1 plus 6 minus 1. So for this particular Aave session, we're up 5.6%. Okay? Now imagine if you tilted and suddenly took some unnecessary trades that don't fulfill the criteria or anything, and suddenly we're down 10%, right? So let's go to Fartcoin. Okay, Fartcoin. Let's bring out our trusty calculator. Let's say we took this trade only, not this, because this is the main trade. So 3 plus 1. We took an L here. That's absolutely fine. Minus 1. What is this? Plus 8.46. Plus 8.46. Minus 1. I won't count the shorts. Plus 2. We took an L. Minus 1. So in our whole Fartcoin session, we're up 11%. See? So if you just follow the strategy, if you just keep your mind, at 100% capacity or 90% even, then the rule of numbers, right? Probability, then you'll still be profitable, right? You will still be profitable. Okay. So now the last part of this video is I will show you guys how to place trades on Bybit. Last part, trading on Bybit. Right. So if you guys don't have a Bybit account yet, I believe there will be a link in the description or in the comments. So just click that and it'll take you to Bybit. Now, for confidentiality's sake, I will use demo trading and I'll be right back. Just to bring out the Bybit platform. Okay, so for the last part of our video, like I've said, I'm gonna show you guys how to place a trade on Bybit. And if you don't have a Bybit account just yet, then check out the comment section or the description to see the link. Okay, so I'll give an example here. So let's clear up everything. Okay. So what you want to do, for example, Fartcoin, we mark out our demand zone. Okay. Here's the long position. Oh, but before that, sorry, let's just use Aave because you have to make sure the chart is the Bybit chart. So Aave USDT perpetual contract swap Bybit, right? Because if you use Binance, then obviously Binance has a different chart than Bybit, so the values may seem off. Okay, so let's clear this up. So let's say you have your demand zone, right? Just click this entry price. So copy the entry price, go to your platform. For this, let's use Bitcoin. I mean Bybit, sorry. Aave USDT. You go here, limit. Okay. My limit price is $294. Make sure to check the TPSL, right? So here, here our stop loss is 289.85. Okay, something like this. So you can see here the expected loss, 598, right? So rule of thumb is usually 1%. So if you have a $100,000 account, like this demo trading, if you have $100,000 account, 1% of that is $1,000. So you can move it up, right? Expected loss, 1,063. That's roughly 1%. Okay. Now the take profit is for this trade is 325, right above here. So the expected profit is 7,849. So that's 1%. And then once you've set everything, click long, limit buy confirm, and there you have it. Right? There you have it. Extremely simple, right? Extremely simple. And you can do this on your phone, you can do this on the PC, but make sure you're at the Bybit chart, right? Make sure you're at the Bybit chart. So yeah, that concludes the video. I hope you guys learned something after watching part 1 to 3. And if ever you guys are interested in the mentorship, you're gonna work with me personally. So if you like how I do things, just hit me up, or there will be a form somewhere, and apply for the mentorship. So I'll see you guys in the next.